Hello everyone. Today we are in discussion with Rahul Singh from Tata Asset Management Company. He is the CIO there. Rahul is a veteran in the industry with over 20 years of experience in the industry. He has been before Tata. He has been associated with Standard Chartered Securities and Citigroup as head of equity research. He is an alumnus of IIM Lucknow, and as many people would be know in the industry for a very long time. So today we'll be discussing with him in terms of the current market scenario. How does he, what guidance would he like to give to a lot of investors who are out there who might not be having a great experience in terms of whether it is the debt markets or the equity markets as of now. So welcome Rahul to the conversation.
Thank you, Ankit.
So if I missed anything, Rahul, if you would like to add about Tata Asset Management or anything about yourself, feel free to do that.
Sure. Thank you for this opportunity. And I joined Tata Mutual Fund now 1.5 years back. My previous experience on the buy side was running my own fund for about 3 years, till from 2015 to 18. And before that, I have spent a large amount of time on the equity research side. So basically on the fundamental research covering a lot of sectors and companies. And at Tata Mutual Fund, I think we are trying to put a lot of those process and systems in place. Our performance has improved, but it's a job half done. We want to continue doing that, and obviously, situations like these make it more challenging. But I think that's where I would like to tell you more as we go along in this conversation about how we are thinking and how we are approaching these markets.
Sure, Rahul, great. So I guess given the current times that we are living in, a lot of people would be perturbed about the volatility that is surrounding us, and that's true for both debt and equity. So how would you explain and tell people as to that this is probably the way it happens in the markets, that they have to stay calm? What would be your suggestion to those investors?
So I think what we are seeing is obviously very, very exceptional kind of circumstances. First, approaching safety first, and then looking at anything apart from safety much later. And the same thing is happening in markets. So when you're looking at investors or fund managers or foreign institutional investors, they are looking at the markets from a safety first approach, which means that if I have to sell stocks of even good companies like HDFC Bank, I'll sell and sit on cash. So those are the kind of questions which are there for which there are no real answers, and therefore this volatility is coming out of that.
Yeah, so basically, I understand that point that probably the future, the near term future at least, is quite uncertain and nobody can put a finger as to where will it get sorted and when.
What we have to think rationally is that from a valuation perspective, where we stand, and that should give you a fairly good idea of where the bottom can be, and whether we are already past the bottom, can we go back there, and if we go back to the bottom, how far is it from today? So if you look at today, the valuation for Indian markets, it's about 15 and a half times P multiple. That is a very difficult question to answer. I think it can happen at any point of time, whether driven by news flow in US or India, on the impact of the economy, what impact it is having on the government finances. At the same time, there is a risk that we may not hit that bottom. We may not go down 10-12% from here, because government is also reacting, RBI is reacting, government is likely to come up with a fiscal stimulus sometime in this week. So we have to therefore not really wait for the absolute bottom, which in my view is anyway 10-15% away, not too far away. It's not like I'm expecting 30% correction from here also.
Mm-hmm.
So we have to start deploying gradually, and on every correction you have to keep deploying. So ideal would be that obviously you deploy 100% of the money at 10% lower levels, but that's not going to happen, because in between government will also do something. They will also come up with a fiscal stimulus. RBI has done something. So we have to therefore start allocating slowly, gradually over the next 1 or 2 or 3 months, I think you will have to keep deploying gradually. Because as I said, I think it's a question of 10-15% here or there. Typically, from the current valuations, if you look at it from a 3-year perspective, the returns have been pretty good. At similar points, if you go back in the market and see at these points of time, if you had invested, you make much better returns over the next 3 years.
Got it. Got it. So in summary, basically, it is like saying that probably the downside might be there, but it is fairly limited, and hence you should be investing in the markets clearly is probably the takeaway from here. Uh,
Yes,
but
I would like to add one more thing. I think it also depends on the individual situation. And the best example I want to give is if any of your listeners is in, say, an industry, working in industry which is totally impacted by the virus situation, whether he is in the travel industry or, let's say, hotels industry, he should be more careful than someone who has a steady stream of income, whose job is secure, whose industry is not impacted, say someone working in FMCG industry or a doctor, obviously has much more security of income. So I think one should not generalize also too much. You have to look at your own situation and how much job security you have given what is happening in the world, and also take that into account before you start committing more money into equities, because equities in general will be a high risk high reward trade off from here, so you will be taking risk if you're buying.
sure, sure. Uh, so, I guess some investors are also in the dilemma as of now that given how the SIP returns have been, the SIP returns in mid caps and small caps, even before this crash happened, they were not doing great in terms of SIP returns. And now, clearly, those will be in big negative in big time, right? So, basically, the point that is now coming whether this SIP might be a great way to invest, but has it actually helped the investors? What will be your experience, say, in your funds or for that matter in the industry?
So SIP, actually the ironic thing which happened in SIP is that bulk of the growth started from 2016, late 2016 and 2017, 18. And therefore the experience has not been great, because obviously there was a peak in 2017, and after that the correction has been relentless, especially in mid cap and small cap. But I think the very point of SIP is to continue during these times. Otherwise, you would have invested in the peak and you are selling now or discontinuing now. It just is totally counterproductive.
Mm-hmm.
So you have to take advantage of today's prices also.
Sure.
So you have to buy, you have to continue it today. Otherwise, there is no benefit of starting it in 2017. You will be losing both ways. So that is a point number one. The second point I want to make is that mid caps today are trading at 10-15% discount to large caps. In 2017, when your SIPs, some of the SIPs would have started, mid caps were trading at 50% premium to large caps. So therefore, there has been a huge decline from a 40-50% premium to a 10% discount. And this, in my view, is absolutely the right time to be continuing the SIPs in mid and small, because not only has the overall market corrected, but the mid and small have corrected much, much more than the large caps.
But then the question that a investor might be having is that, say, I did a 5 years SIP and I have not made any money out of it till date.
Mm.
So I understand, and most people would also understand that in equities you have to stay the long term, but that long is becoming longer, right?
Yes, yes.
And hence, what should an investor be prepared for when he's entering all this? And probably a related question would be, are we going into a scenario in financial markets where the cycles are becoming shorter and more frequent, and hence predicting them is becoming slightly difficult, and hence you have to stay for longer? I might be completely wrong. I would like to know your views.
So you're right. I think in the last 5 years, if I remember, if I look at it from 2015 also, um, I think the problem which has happened is that our economy has also gone through multiple shocks, which is uh, after the high hopes in 2014, I think 2016 demonetization, then GST, and then obviously the NBFC crisis, and finally the coronavirus. So we've had four large events, I would say, which have impacted the market returns in a 6 year period. So in a 6 year period, you've had four big four big disruptions, which is very rare. And what we are seeing in 2020, therefore, is a almost a climax of that, which means all the four things are coming together and pulling down the returns, which is why over a 5-6 year also you're not able to see the returns. But I can tell you from personal experience that the inequities, the returns get made up very fast, and I don't think there has been a decade where the entire decade has gone without making any returns. So even for India, for example, if I look at from a dollar perspective, from a dollar basis, also there's not been too much return which has been made in the last 5-6 years for FIs also, because US markets have done very well and the emerging markets have done very badly. But now I think once the tide turns and it turns for 5, 6, 7 years in a go, you tend to make up for that in a very large fashion. But again, as I said, equities is never without any risk. So even now when you're buying, all you're trying to do when you're buying at these valuations is that you're minimizing the risk, but you're not eliminating it completely. So if you buy today, you are eliminating the risk. If you buy 10% lower, you will be eliminating more risk, right? And therefore you have to try and manage your risk. And then it goes back to even the original question, original situation, that it also depends on your personal situation. So if you think you can take more risk, then you have to start buying today. If you think you should not take more risk, then you have to wait for another 5% and then start buying. But I think what you have to understand is that these 5-6 years have seen a lot of changes, a lot of external events, and therefore it's unfortunate that these 5-6 years are the where the returns are not visible. But in equities, if you look at it, I think after these periods, typically you will see when the recovery comes, it can be really very sharp, and it can tends to tends to normalize all the pain which you have seen. So I'm very hopeful of that. I think if this coronavirus situation had not happened, you would have started to see our economic growth already lifting up, because we had a good monsoon, we had a good rabi crop in India, the NBFC situation was settling down. So everything which you could see, things were settling down, and we would have looked much better in terms of the economic growth rate. Now with this coronavirus, I think the whole thing gets delayed by 1 year. So you have to be prepared with the situation that next 1 year you may not get very high returns. Okay, but that doesn't mean you don't invest during the next 1 year or during the next 6 months.
So, what will be your suggestion to a regular investor in terms of looking at, say, both debt and equity? How should he be positioning himself? I understand it is based on risk profiling of each individual and those things, but say a moderate individual should be positioned in debt and equity in which manner, in which proportion? Because in debt also, the regular funds, the low duration oriented funds are close to say 5% odd, with interest rates being cut for all the government schemes also, savings account also. You can't make much returns there. But say for some things like, say, even the GSECs are still trading at fairly good yields. Even the state bonds are at certain good yields. So what will be your suggestion to a regular investor, given the uncertainty in equity markets?
So assuming that if your personal situation in terms of job security, etc., is normal, if you are less than 50% in equity, you should go more than 50% clearly at the current valuations. If we get further correction, then you should go towards 65-70%.
Okay.
So today, if you were to ask me, I think you should be somewhere between 50 to 60% equity. Of
Okay.
course, individual variations can happen depending on risk appetite, his own personal situation, saving situation, and job situation. But I think one should be definitely more than 50% in equity at the current valuations and keep raising it um, as the valuations come down. One of the products which we run, which is the Tata Balanced Advantage Fund, does precisely that. So we were at 40% equity allocation in early March. Today, because of the market decline and because of our valuation models, we are at 65%. So in 1 month, 1.5 months, we have moved from 40, 45% to 65, 70%. So that is the kind of huge swing our models are showing in equity allocation. And I would tend to recommend the same thing for even for the individual investors. Because as you said, debt returns are not going to be great. You will see that even banks are cutting deposit rates, small savings rate is cut down. You would continue to see that the uh, yield which you will make on safe debt funds, AAA debt funds or etc., will keep coming up.
Correct. So I guess the takeaway for some people is that, as you say, the safe debt funds, because there are certain funds which are trading at fairly high yield to maturity also, but then there might be that underlying risk that is being carried in those funds because a lot of sectors are under stress and hence the yields for them will clearly be higher.
Yes, yes, yes.
Okay. Lastly, as you said, we should be probably going towards equities as the market is correcting. So, what is your sense in terms of the say the market cap composition that you should be having? Like, basically, when this all starts recovering, largely it should be that large caps will recover faster than the smaller caps and the mid caps, right? So, should one be positioned more towards say large cap oriented, multi cap oriented funds compared to small mid cap? Or anything else?
Ini- Initially, yes, you're right. Initially, large caps would tend to recover more. So you could have a large and mid cap fund or a large cap fund. That is the best way to play it. But I think eventually, if the recovery happens, I think it's a question of if, not when. Then the small cap, mid caps can give you better returns than large cap over a 3-year period. So large cap, yes, for the short term, for the next 6 months or 1 year. But for a 3-year perspective, I think mid and small, like I said, are trading at
Mhm.
significant discount to large caps.
Mhm.
And therefore, when they start performing, they give you phenomenal returns in just 1 year. See, unfortunately, what happens in small cap is that you get 60% return in 1 year.
Correct.
You don't know which year that is going to be, whether it's going to be 2022 or 2023 or 2021.
Correct.
But you have to be positioned for that. So today, if I were to put say 100 rupees in equities, I would not put more than 10 rupees in small cap.
Mhm.
But once the large cap recovery happens, I would keep increasing that portion gradually
Sure.
because you can make a disproportionate return. Only thing is you will have to be patient. Uh, and the year in which you get 50% return in a small cap fund, you should exit also. I think it's very important in small cap
Yeah.
to remember when to exit. And that has been the mistake which everyone has made, that most inflows come during the time when the funds are doing well. So when you make a 50% return on your NAV in a small cap fund, that is the year when you should exit that fund.
Mhm. Mhm. Okay. Okay. Uh, got it. And in terms of like say, uh, since you have spent so much time in the industry, what would be say key learnings from the crashes that have happened in the past that you might want to share with the investors and the millennial generation who started investing over the last 2 3 years and typically would be running towards fixed deposit as of today, saying that okay, my money is much safer there, I don't have all the tension of whether it's going up and down, and probably gives me some positive returns clearly rather than all these negative returns that I'm seeing. So, what will be your suggestion to them? Learnings from the earlier crashes.
Yeah, so we have all done that during the time of crash, but I think every crash or every recession feels equally uncertain at that point of time in which it is happening. So I remember in 2008, 2009, when I was working in a global multinational bank, Citibank, where US was going through huge uncertainty, and there was genuine issue of your own job security. Forget about investing in the markets. So when you are in a situation where you are in an industry, and I have been part of that industry in a company which was going through deep stress, your first reaction is to obviously protect your savings. And to that extent, it goes back to the original point I was trying to make, is that it is extremely important that your behavior is in sync with your own industry prospects, or prospects of your employer industry. I think it's very important. But if you are working in a if you're working in a as a doctor, or if you're working in healthcare, or you're working in a FMCG company today, you should not be worried about it. I think you should see it as an opportunity. That is the learning I have, that you should see it as an opportunity, and remember that each crisis feels like it is not going to get over. It happened in 2001 during the dot-com bust when I was part of it. It happened in 2008 when I was even a bigger part of it. So therefore, each crisis feels like, this. The next weekend you're going to lose your job, but it kind of blows over. And this is a medical crisis, so this is a unique situation, because this is not a man-made or a banking sector situation like it was in 2008, 2009. It is a output crash and demand crash also. So both are happening simultaneously, and I think that is what is creating this huge uncertainty. But I would be very surprised if there is no drug or vaccine which is discovered in the next 6 months or maybe 12 months, which will not solve this situation.
Sure. Sure. Last question from my side, Rahul. Basically, a lot of investors would be, given the valuations that there are, a lot of people might be buying individual stocks and sectors and those things. So, if you can leave us with some thoughts as to which sectors might be doing well, say in the next 1 or 2 years, and what are particular avoids as of now. And a second question, which is probably a more of a debt related question, in the sense that, do you think that we are in for more accidents on the debt side, whether it is anything, whether it is NBFC related due to the current crisis or anything? If you can just give some pointers.
So on the equity side, definitely pharma and healthcare is one sector which we are looking at more positively than in the past 2 years. I think that sector looks the sector to be in from a next 2 to 3 year perspective. Also because there is going to be so much focus on healthcare as a segment. So whether it's a hospital company or a diagnostic lab company or a pharma drug company, I think there is going to be significant kind of tailwinds for that sector to do well. The other sector which I think should do well is telecom, because it's proven now that telecom is our backbone. The way we are having this call would not have been possible if we didn't have robust companies on telecom. So I expect that telecom industry will consolidate. The companies will become healthier. They will earn more revenues. So that's another sector which we are looking at it. And the other third sector which I would like to highlight is in the insurance side, because what this event has done is to raise awareness about having enough health insurance, enough life insurance for ourselves and for our families. So therefore, insurance as a sector, I think behavior will change. We will find it more and more necessary to have health insurance and so on. So these are the three sectors which I would think would come out of this situation stronger and growing faster. On the debt side, I would not like to comment because that does not come directly under me, but I can only say that I think NBFC, because they have been undergoing a crisis since 2018 September, since ILF has happened, a lot of NBFCs have corrected their balance sheets in terms of their dependence on short-term liabilities, etc. So therefore, I would think that the balance sheets are much better. But what this what the COVID situation has done is to create a demand shock. So how the companies cope up, especially on the SME lending and the retail lending side, one has to be a little careful. It's obviously an evolving situation. I would think that government and RBI are now there to support, because this time the problem is not because of the NBFC managements making some wrong choices. This time the problem is more external. So therefore, this time the government will not let the accidents happen so easily, because it's a situation which is not because a certain company made some wrong decisions like you have seen it in the past. So therefore, I'm more hopeful that at least from an accident point of view, there is less likely.
Thanks, Rahul. It was a great, interesting conversation, and I guess it will help our investors keep their faith in the equity markets, given the situation right now. So, thanks for this.
Thank you, Ankit, and thank you to all the listeners. You're welcome.